Eric, we're back. You are the AI investor. I am your host, Austin Smith, and we are celebrating a really ridiculous run in the portfolio the last week. And I just wanted to talk about some of the crazy performance we've seen. This is one of the strongest runs yet that you've seen for AI stocks. And that is saying something in an industry that has been extremely volatile to the upside in the last year. And just for context, the average return of your stock pick in the portfolio hit 53% at market close Thursday. Now, the portfolio has been active for roughly a year, and the portfolio is now up $135,000 in returns on a $500,000 investment. You had some cash drag there in the first half of the year, so that's a really remarkable number. But I want to call out being able to get a 27% return with a cash drag is impressive. And just to put in context how big this recent run is, just 1 month ago, the average return return for your picks was 25%. So it's basically doubled in 4 weeks. So this is crazy. It seems to be largely driven by earnings and sort of a step up in enthusiasm, specifically Broadcom and Oracle. But what else are you seeing out there? I mean, what are you seeing that's causing this shift? Is it a vibe shift? Is it interest rates? Is it all the above? How do you feel about the portfolio right now?
Like you said, it's remarkable. One thing we'll always keep in mind that stocks tend to go down faster than they go up. This has been going up very fast. But so we always stay humble about this and remind our viewers we believe the trajectory for AI continues to be up and to the right, but this will be it's not a continuous path, right? There's ups and there's downs. We are in a period of extreme ups. Like you had noted, what's driving this is a lot of optimism about high level news. We're going to get into it on these earnings, but there is some, or on this podcast, I should say, there was earnings from Oracle that were astounding. Perhaps one of the most astounding earnings I've ever seen.
There's potential watershed earnings out of them. And I know we'll talk about that later, but I really want to put a little bold on that. I mean, this feels like it could be like a reflection of NVIDIA's blowout earnings after the GPT moment. And this feels like it could be another watershed that shifts the industry in one direction. I know we'll talk more about what that means.
Yeah. No, 100%. That's a little bit what it feels like. NVIDIA in March 2023. And then the macro environment's been very good, and we'll always kind of pay attention to that. We finally got, I shouldn't say finally got, we got a rate cut, and with expectations of 2 rate cuts coming in the next year. So we've seen a lot of rallies in more small and speculative stocks. Yesterday, we had Ouster, which was our most recent recommendation, up 13% in a day. We had large kind of geopolitical news with an investment into Intel. So there's a healthy mix of good actual news happening specific to the AI space in things like Oracle's earnings. And the macro side between rate cuts and also some of these investments into businesses is also fueling this rally. So Austin, it's just, no matter where you look at it, it's a period of extreme optimism. Expectations for spend continue to go up. Some of the areas that led to a lot of fear earlier in the year, we spent many episodes deconstructing why DeepSeek was overblown, why concerns about Microsoft cutting leases on data centers was misunderstood by the market. This past week, we saw Microsoft announcing their biggest data centers ever, signing $17 billion deals with Neoclouds. So a lot of the areas that created an overhang in the market at the beginning of the year are now absent, and it is a time that the bulls are running wild.
Now, Eric, we are not macro investors, but you shared a really great note from Fabricated Knowledge that I want to talk about the overall state of the AI market. And there's a couple really important things in here as they relate to Oracle's earnings. The thing that stands out to me the most is we are looking like we are now about to move from the cash flow funded era of AI investment to the debt fueled era of AI investment. And that has some really positive but also volatile implications, because at a fundamental level, debt is leverage, and leverage causes volatility. Now, people shouldn't be scared by volatility per se. They should be aware of it, because volatility means to the upside or the downside, right? Leverage can go in both directions here. So can you talk a little bit about that? Now, that's the piece that stood out to me the most. I know there's other elements in here that are interesting, but can you talk about Oracle's earnings and this phase shift that we might now be entering in? And I just want to pause for a moment and reflect. the rally that we've seen in this last couple of years in the AI sector has largely been cash flow based, and that is incredible. So to anybody who was calling this a bubble up until this moment and trying to compare it to other rapid appreciations, there was already leverage and debt largely built into those markets, whether it's railroad or Japanese assets or U.S. home values in 2009. This has been largely cash flow funded up until this point. So we're now, if we're about to hit the bubble era, it's now at the beginning of what most bubbles look like. But I'll let you explain that. Let's go on. What was that note about?
Yeah, it's such an important distinction because you look at .com, the biggest companies like Microsoft or Cisco at that time, they might have had $1 billion or somewhere directionally in that era. Kind of that was their amount of cash they were throwing off. At the beginning of, the AI boom, the largest tech companies have $100 billion in cash flow, which they've been using to finance. So it's a really important distinction that back in .com, when we were laying all this fiber and all the things that turned out to be an overinvestment, that was done through debt markets and areas that had a wider spread throughout the economy when, turned out to be an overinvestment. So you mentioned Oracle's earnings. Austin, they were just a stunner. We'll come back to them several times across the podcast, but I do need to put into perspective what they announced, Austin. So the headline, there's a figure RPO. It's basically the backlog for these cloud companies. They announced it had gone up to $460 billion. Now, for perspective, Amazon's RPO is at $195 billion. Microsoft's $315 billion. Google's $106 billion. So we're talking anywhere from 2 to 2.5 times bigger to 4.5 times bigger the other hyperscalers. Now, here's what's amazing. Amazon's market share in the most recent quarter was a little above 30%. Azure's is about 20%. Google's about 13%. Oracle's 3%. So, Austin, Oracle is presently 1/10 the size of Amazon, and their backlog is now 2.5 times bigger. And it just appeared. It just happened in a single quarter. Also, Oracle pre-announced guidance up to 2029. I've never seen a company, getting guidance to the next quarter. A lot of companies don't even want to do that. And this company just announced guidance to the end of the decade. This is just, wow. Again, the comparable is kind of after ChatGPT, I believe it was in March of 2023, NVIDIA announced a quarter and all of a sudden it was just every metric just flipped. And you're saying, what is happening? This is some remarkable stuff. And what is happening in the background is something we've talked about mostly at the beginning of the year, but Stargate and the fact that OpenAI has had very ambitious plans. And Microsoft effectively said, hey, you're coming to us, wanting us to create an allocation of $500 billion plus, and you're making about $10 billion a year in revenue. We're not going to go along with this. And Oracle said, yep, we'll support you in this. And it created a larger consortium involving not only Oracle, but areas like SoftBank from Japan and other companies. And they are going ahead with these plans. So, you have Microsoft maybe as a loser here and an inroads for Oracle joining the ranks of these largest companies. And maybe, Austin, a larger inroads. We're going to talk about the broader Neocloud space later. But what is the larger kind of economic setup, knowing, this Oracle news that's now been revealed? Well, we've got a lot of areas kind of coalescing together. As I talked about at the beginning of the podcast, we saw a 25-point rate cut. We're expected to see 2 more in the coming year. We know what Donald Trump's bias is in this area. He wants rates to go. He would love to see them at 2%, and he's going to have a chance next year to appoint a new Fed chair. So we have a situation where rates are definitively at this point pointed downwards. We have the situation you mentioned that we have a market that has been funded through free cash flow. And in 2 fell swoops, number one, Meta's announcement of their capital plans for next year was a big event earlier this summer. Number 2, Oracle's announcement that they're going to basically go for being OpenAI's main, customer for compute, funded through debt, is another one. We're moving to an era where we are moving from cash flow to debt, which will again be funded by these lower rates. 3, I talked about Donald Trump and his drive for lower rates. There's also a government drive to create more investment in the country. And what's the number one way that you can create investment right now? Well, there's a reason the government's taking a stake in Intel, which we'll talk about more later. There's a reason that Taiwan Semiconductor is building fabs. Bringing high technology back to the United States is one of the most efficient ways to drive an investment cycle that will lead to kind of large economic gains, especially that you can point to in midterm elections that will be coming up next year. And don't lose focus of the fact that there's going to be a lot of positioning around how the economy is doing headed into these midterm elections. And finally, we have ASI as a goal, with the leading players in the AI space saying they are in a race for it. Again, with ASI, the idea of these models becoming more intelligent than humans shortly, a lot of it creates an existential race where you have players that will spend beyond a rational limit of what kind of returns you're getting for the promise of being the first company to harness this, because it creates areas like recursively improving models that could create an enduring advantage. So Austin, it's just, I wanted to, this is things that we've talked about in this podcast. It's things that were highlighted in that Fabricated Knowledge post that you referenced. But I wanted to put all this together because we are seeing returns. The average return we've got 34 recommendations we've issued. We always keep where you can view the portfolio in our show notes if anyone wants to go and look at the stocks we've recommended. But there is kind of a situation where we are pushing into something beyond. When the podcast started, I said spending on AI is a lot more rational than people think. We are not in a bubble situation. I see this increasing. We are moving to a situation, this may be the beginning of a bubble. Now, does that mean that you shouldn't invest in this space? Not necessarily. Every single technology becomes a bubble. This is a cycle we go through. It could last for several years. It's relatively normal for large world-changing technologies like this to have some period of enthusiasm beyond near-term economic returns. And also, what's the worst thing you could have ever done during the internet? Would have been tuned it out in 2001, right? There's always going to be, if this is an enduring megatrend, even if there are some fits and starts and ups and downs, it's going to define where you discover returns across the next decade, even if there is a period that exuberance maybe runs too hot. Mm-hmm. But I think this is where a lot of people are looking maybe at 53% returns in less than a year and saying, this feels like it's too much. Well, we could actually be at the beginning of a very torrid ramp across the next 12 to 24 months, with all of these events coalescing into a fervor, unlike anything we've seen so far in this market.
Yeah, beautifully said. And I don't want to get too stuck on this point here, but I'm going to try and just summarize that for our listeners. We have the convergence of Fed rate cuts, funding moving from cash flow to debt, which to me is the largest leverage here, which can cause this, let's say, environment to continue for multiple years to come. The government's enthusiasm here, and ASI as the next main goal, being sort of a convergence of factors that is likely to cause a lot more upside in this space. Now, we also want to be clear, these will also cause volatility, and volatility does cut both ways. So I would not be surprised to see a lot of our stocks in the portfolio maybe down 20 or 30% on a little bit of a hiccup, a little bit of a scare, particularly the small caps. That doesn't mean you don't want to be invested in this space. That means doing what you've always tried to do, which is having a portfolio strategy, position sizing accordingly. Your smaller, more volatile positions like Tecogen and Applied Optoelectronics, which were two of your more recent ones, are sized to reflect that risk. But you still want exposure to this space, particularly with that convergence you're talking about. So, yeah, I know there's more for us to talk about. We want to get onto Neoclouds, but given that this Oracle earnings could be sort of a bit of a seminal watershed moment, I wanted to talk about that. And one last callback, that same Fabricated Knowledge post you referenced cited a book that reoriented my mind around bubbles a little bit, and that's called Boom, Bubbles in the End of Stagnation. It talks about things like the Manhattan Project, the Apollo program, Bitcoin, fracking, and sort of how you get these exuberant investments in technologies that create this foundation for entirely new industries and they're not necessarily bad. They create this new order and new investment opportunities that never existed before. So anyway, let's move on though, because there are a lot of other items to talk about. Do you want to talk about this OpenAI release? Do you want to talk about more about the portfolio? Where are you at?
Yeah, we'll hit a few news items. Maybe we'll have to do an AI investor book club coming up next.
That's right. We've
You'd
recommended a
have a
couple
lot.
books.
Yeah, you'd have a lot of recommendations there. So I think just a few important things we'll hit on. The three news items, and we'll also touch on earnings as well after this. We had a release from OpenAI, I think is worth talking about. We have an Intel NVIDIA partnership that was announced the day before we're filming this on September 18th. And we have a relatively large partnership in the robotics space. So I'll start with OpenAI. You know, clearly from what I had just discussed in the prior segment, OpenAI is increasingly driving a lot of the activity. They were the catalyst for the biggest gains for not only Oracle, but also a company we'll talk about that's in the portfolio in Broadcom in the past 2 weeks. And that's driven by their very large spending plans. They don't lead in every single area. OpenAI leads in consumer adoption, as roughly 700 million users. But things like recently, Google announced Nano Banana, which is really cool for being able to edit multimedia. It's something that's definitely ahead of OpenAI's capabilities there. Another area is coding. Historically, this is an area that Claude from Anthropic has been ahead in. That means that Anthropic can have a significantly smaller user base, but be relatively closer to OpenAI in terms of revenue. What happened is OpenAI released Codex, which is their solution for coding, and it's led to 3 times more usage in the past week. So as we talk about Oracle with these massive plans, we talk about Neoclouds, one thing that's happening is we are seeing a massive, massive rise in inference, or actually running these AI models. This is what's driving so much of the, plans for 2026, 2027, coding something at the forefront of it. And if OpenAI is able to gain market share here, what's it going to mean? Well, all the posts I've seen in the past week or two from people at the company are, our GPUs are melting. We need more GPUs. We need more GPUs. So when you see things like Codex getting this much traction, it just continues pouring more fuel on the fire. At the end of the day, as we've said since the start of this podcast, either we're going to be using these AI models at scale, we're going to see things like agents pouring fuel on top the needs for inference, or this isn't going to work out in the way we expected. And every single time we see massive use cases, it's good for the industry itself. So I thought this was positive news.
Yeah, absolutely. I had sort of considered OpenAI the front runner of like an AGI model, whereas there are things like maybe Nano Banana or Claude, which you talked about, which might have been more specialized models. But maybe this shows that they're actually the biggest generalized model and specific models in the future. Who knows? It changes so fast. I'm sure there will be another model released next week we'll be talking about. I want to talk about this tie-up of Intel, NVIDIA, and a shout back to, I think it was our August 1st episode. We talked about sort of these fallen domestic champions, Intel and Marvell, and maybe how to play that. You have a position in Marvell in the portfolio, no position in Intel. We had alluded to, though, privately that you put some options on Marvell, and that this concept of maybe, hey, these are two companies where the government, I believe we actually said this. Someone should go back and listen, or maybe Brad, if you can find the clip and play it. I think we had said, hey, these companies are ripe for government intervention. Put an option on it. When you see companies like Marvell, and let's just throw Intel in there as well, where there is a major movement to bring manufacturing back to the US. AI is this multi-billion-dollar race, and there's a lot of capital that's going to be flooding through there. And you and I have referenced the book Chip War in the past, and just how much domestic government or federal investment set the US chip industry on an incredible multi-decade trajectory. Feels like we might be at a similar moment where there's a lot of domestic, major infrastructure spend. is it worth investors considering like some call options on a Marvell or some call options on an Intel? Very low percent of your portfolio, but these companies that are domestic champions, serial underperformers that need a lifesaver. But if they get one, they'll re-rate very quickly. Is that a way to play
I feel
these?
like you're setting me up here. You're setting me up, Austin. Yeah, I own call options on Marvell, in part because of this kind of optionality, where if these contracts do play out, they will be worth significantly more, and if not, in some ways it feels low superior to buying the shares. Of course, that's dependent on how aggressively options are priced. But no, that probably is, if you were purchasing it today, the superior play, and it just comes down to timing. Will they re-rate by the time your options expire? So if you're doing that, you'd probably want to look out to 2027.
I'm curious if any of our listeners did that. Now, Marvell has fallen quite a bit, but NVIDIA's had a much better run. They got some federal investment, and now they've got to tie up with the golden child, NVIDIA, investing $5 billion. In hindsight, that makes perfect sense because Intel, of course, what separates them is the foundry. So can you talk a little bit about this partnership and why, I'm not going to suggest that Intel is a front runner in manufacturing here, but what is the thesis behind? I mean, they're obviously still an incredibly talented company. What is the thesis behind this? Why is Intel sort of the preferred candidate here domestically?
Yeah. So there's some separations of what this deal is and what it's not, which we'll break down here a little bit. Most importantly, Intel needs cash. So, they're cobbling together all these deals, supported by the government itself. The government now owns 10% of Intel. As part of this deal, NVIDIA now owns 5% of Intel. It was a $5 billion cash infusion. And they need this cash to be able to keep executing on their strategy of becoming a foundry that will attract major customers. So now what this deal is not, it's not a foundry deal. So Intel is not going to actually use Intel to make its chips. There's nothing that says that their relationship with Taiwan Semiconductor, which of course is a stock we own, that's done very well. There's nothing that says at this point they are moving their business away from that. What this is, we've talked a lot about NVIDIA's next generation systems that cost millions of dollars, like the GB Ultra, which is right now kind of the one everyone would sell their first child to get access to. They use an ARM chip. And ARM uses a competing instruction set to Intel's x86. So if you want to use Intel chips with GB300s, it's going to be much more inefficient. What this deal provides a pathway to is that in future designs, NVIDIA is going to create an x86 version. So this creates a pathway for Intel to stop losing so much market share for its CPUs in the data center. I'll say if you're an optimist, what you could probably compare this news to is in the late 1990s, Apple was fading. Microsoft needed to prop up a competitor, and they did a 5% investment in Apple. We obviously had Steve Jobs come back. You could compare that to Lip-Bu Tan for, Intel, new leadership, and it created a new era where obviously we know what happened with Apple. But I think, Austin, the headline is, there's probably a bit too much optimism about this being kind of the birth of Intel's new strategy for making chips for new people. As I said, that's not what this deal necessarily is. But what it will create optimism around is this is likely the first of many deals brokered by the US government. And this is why the superior way to have been playing Intel, which many people did. There's a very notable hedge fund that I believe made something in the ballpark of $1 billion off Intel options on this announcement, is it was kind of an options trade for the idea that once these deals started flowing through, we would see a quick re-rating because we would see deal after deal in succession. I believe this is probably the beginning of that. So for anyone who had options on Intel, good job by you. This was a is it going to happen or isn't it going to happen situation, and the floodgates seem to be opening up here.
Yeah, I'd love to hear if any of our listeners rode that rally. Leave us a comment, Spotify, YouTube. Hey, a quick shout out. Please rate or review us on YouTube or your various podcast platforms. It's how we get discovery for the show, and we want to get circulation out there. Quick little plug there, Eric. All right, I want to move on to my favorite news item here. This is a small one. We got to be quick, but I'm the most excited about this, which is the partnership of Brookfield and Figure AI. our listeners know I'm kind of the robotics guy. I love the robotics side of this, but that I'm also the real estate guy. And outside of our work we do here, I love real estate and property. So Brookfield is one of my favorite companies. Really impressive, sort of Canadian conglomerate. They have this various like Russian doll structure of like Brookfield infrastructure partners and energy partners and capital corporations. So there's a whole lot of Brookfield companies, but one of the fundamental sort of foundations there is real estate and property management. So this seemed like a very odd partnership at first blush, but they are investing a big amount of money in a robotics company called Figure. Eric, tell me about the news and what was. It seems like an odd pairing, but what was it that actually makes sense about the training set here and the properties in Brookfield's portfolio and why that helps Figure and vice versa?
Yeah, you said it. World-changing trends make odd bedfellows. Brookfield and a startup like Figure, you have never expected. So a little background: we've talked about Brookfield being a very attractive, low-risk way for people to play the AI trend. We've talked about the stock before. You can buy the parent company, which trades under ticker BN. You can also buy Brookfield Asset Management, which has more of the AI specialization, that trades under BAM, I believe. And we've talked about Figure being one of the most compelling robotics companies with one of the largest visions and, it seems like early execution. So Brookfield, Austin, why is this an interesting deal? Well, it's going to be all about providing pre-training data sets for Figure to be able to figure out and to train how we take robots and put them into real world environments. Why Brookfield can provide this? Well, they've got 100,000 residential units, 500 million square feet of commercial office space, also 160 million square feet of logistics space. It should also be noted this past week, Figure raised a new round at $39 billion, with Brookfield being one of the lead investors. So I think this is really win-win between these companies. Brookfield gets a pilot project that, if robotics and the data needed for robotics becomes one of the most in focus areas, they're building out a pipeline for revenue sources there. They have a direct investment. They're going to be able to use this as a pilot project in the future. For Figure, it's ambitious, and we like them because they're ambitious. We like the ambitious companies at the beginning of a megatrend like robotics. If they were public, we would almost certainly own it in the portfolio. Unfortunately, they're not. There are some pathways to being able to get access to it in platforms like Robinhood that people could look at. But this is one that if it IPO'd in the future, it would be near the top of our list of interest, and it just continues to show how quickly moving this robotic space is, and people realize this could be the grand prize, and they're going to be very aggressive about it, and we're going to continue finding opportunities that people can invest in it.
And just as a callback, Figure is the robotics company that has had some of the most impressive demos, like the robots folding laundry or putting away things in the refrigerator. And that's where I love Brookfield's portfolio. I mean, imagine if that not only does Figure get all of this really relevant real world training data, but there's a high probability that these companies partner in the future. And Brookfield now has the most advanced automated general purpose warehouses that they can lease, or residential facilities that have robotic enhancements or robotic assistance, whatever the case may be. So I love this. I'm so excited about it. It plays to my two of my favorite investment trends. But enough of that. Let's get on to earnings season and some of the volatility we alluded to at the beginning. I want to talk about Synopsys. This is your electronic design automation company. This is a company where people use software to design semiconductors and chips. So it's think of it as the AutoCAD or the CAD of this industry, right? This is how people actually design the chips, as we're designing ever more chips and ever more specialized and custom chips, be it from NVIDIA or Amazon or Google. They have to use software like this. So it seems like it's perfectly positioned. But you're in the notes, I'm seeing a massive disappointment. What's going on?
Yeah, it's kind of like these past couple weeks, you get this beautiful steak that you're just drooling with all these returns, and then you cut into this grizzled piece of fat, right? That's what Synopsys earnings were in the past couple weeks, amongst what's really been a great market atmosphere in general. This is a difficult subject to talk about, as you can imagine. Synopsys isn't it's getting to pretty hard technology here, but I'm going to do my best to kind of try and distill this down into something digestible. The big news: their earnings were terrible. They missed last quarter. They took their forecast down next quarter. I saw the news, and the initial reaction was down in that 15, maybe 20% range. I figured that's where the stock would end up. That's a pretty normal reaction for a company like this to that type of news. But they were down 35% the next day. So even a little worse. I think they were trading for $620. They went down to $365. It was one of the biggest reactions I've ever seen. Since then, they've bounced back. They bounced back 13% the day after earnings, and they had great gains yesterday on the news of NVIDIA's Intel investment. You'll understand in a moment why that was. But they had a few weaknesses, Austin. We've specifically in this portfolio been steering away from companies that have outsized China exposure. And we've been specifically steering away from companies that there's a situation where the foundries, the companies that make the chips, it continues to concentrate down to Taiwan Semiconductor having a grip. Companies that have negative exposure to this, especially in making the machines that make chips, we've definitely have less of an allocation than I would otherwise like. Just this week, we saw news from the Financial Times that China's effectively told their companies they cannot buy NVIDIA chips. So, well, NVIDIA, there was this kind of quid pro quo where the export restrictions were lifted. China's now gone back and told the companies, no, actually, you can't buy NVIDIA chips. Synopsys is caught in the middle of this because their software was briefly limited towards China. It led to their customers there pulling back. And they're going to be more reticent to come back because they could come back to Synopsys, but all of a sudden in 6 months, they face similar restrictions. So they have some difficulties in the Chinese market. But the biggest reason, Austin, is Intel. and Intel, this is a doozy. Basically, the story is, as I know, there's only 3 foundry companies that have any consequence to building these leading edge chips. And that's Taiwan Semiconductor, Samsung, and Intel. As you can imagine, when you want to design a chip, there's going to be differences if you want it to be ultimately made on Taiwan Semiconductor's technology or Intel. Since Intel doesn't have customers for some of their nodes, they've been paying massive payments for Synopsys to essentially support them. This is wasted money, but it's also a deal's a deal. What happened is the new CEO of Intel, who's Lip-Bu Tan, where'd he come from? Synopsys's competitor Cadence, which is also in our portfolio. What does he do? He cuts this money, and also Intel previously was a Synopsys shop. They basically weren't dual sourcing between them. You would imagine he's also now going to move some of this business towards Cadence. So ex-Cadence CEO comes in, hacks his rival to bits. It's probably something that could be challenged in court, but what's Synopsys going to do? Who owns Intel now? The U.S. government. You can't burn down one of your main customers either because, you might need them in the future. So, Austin, the end outcome here, the reaction the day following was incredibly outsized. As I know, Synopsys went from $620 a share, $365. It's now, as we record this, it's closer to $480. That's probably a more reasonable reaction to this news. It's kind of a one-time bloodletting because of excess concentration in Intel, some deals that didn't have economic viability. But here's the good news. The thing that we own Synopsys for, their long-term kind of cozy relationship with Cadence as the 1 and 2 in this industry, and the overall growth of semiconductors remains on track. So, this is a setback. I'm not going to be adding any more Synopsys, but it's a stock that I've said in the past. It's just kind of a pillar of the industry. It's something you hold that's going to have its ups and downs, but I think will be a winner over 5 years. I believe that still very much remains in play, despite how scary this situation was.
Boy, who needs Game of Thrones when you have corporate drama like that? Just coming in and knifing your competitor, and then you've got the government investing money, and then Intel's throwing you $5 billion, or I'm sorry, NVIDIA's throwing Intel $5 billion. Boy, there's a lot of drama out there.
Game of chips. Game of chips.
I like that. HBO, pick it up. Eric, let's talk about Broadcom. This is a company you've added to the portfolio twice. One of the big drivers of the outperformance we're seeing. Your first investment's up about 88% as of this filming. The second is up about 94%. So hats off to you. One of the things that I've really enjoyed about doing this with you is actually seeing how much these, I don't want to call Broadcom an old world company, but how much tech companies, major tech companies that had one business model have had to completely reinvent themselves. And I remember maybe 15 years ago, Broadcom was sort of the acquisition patent troll, right? They were just acquiring companies and getting patents and removing costs, and that was kind of their business model. And now, they're all about ASICs and they're squarely positioned in AI. Microsoft's reinvented themselves, even Facebook to some extent. Oracle is like the poster child, I think, of reinvention. Every couple of years, Larry Ellison somehow forces that company into a new vein. So I love seeing Broadcom in the portfolio and doing this and pivoting. But let's talk about the earnings, the actual contributor to the portfolio. What did you see?
And I love this point that you're making as well, because if you went back to 2008, 2009, at the time, I was leading technology coverage on Fool.com, and two companies you couldn't have any less interest in were Broadcom, Oracle, seen as leaders in the dot-com run-up, who had lost their mojo and would just kind of whittle away, hanging on to old technology. And now they are the discussion point for the next megatrend in AI. And, who knows? Maybe we'll be looking at quantum computing in 5 years with IBM leading it, right? So,
I was just going to say
what's
IBM. IBM's going through a bit of a renaissance now. I mean, hey, Nokia, where are you at? Like, let's get the old gang back together.
in the game of chips, what's dead will never die. Or what's the phrase?
That which is dead,
that.
which will never die. We could always say winter is coming too, but I don't think we want to talk about that while we're at the beginning of an alleged boom cycle. So I like that which is dead will never die. We'll stick with that.
We're at the beginning of summer
Yeah.
here. We've got a dream of spring.
Yeah.
Okay, so regardless, the big story here is OpenAI again. OpenAI, Broadcom. We do live earnings coverage on 24/7 Wall Street. I remember in December I was doing live coverage when all of a sudden on Broadcom's call, they announced new projections. They called it serviceable addressable market. It was much larger than Wall Street expected, and coming into the call, it had been up, but all of a sudden skyrocket up. You almost never see a reaction like this. We're doing another earnings call for what they just announced in recent weeks. And coming into the call, I think they were up like either flat or at most 4%. I think it was flat. And they do this earnings call and they announce a new customer that's about to scale. And again, for Broadcom, the story is they have a great relationship with Google, designing the company's TPUs. The question is, are they going to be able to repeat that? And they're all of a sudden announcing a customer that's about to scale to $10 billion next year. That customer is OpenAI. But what it does is it allows them to be re-rated by Wall Street, saying, we haven't been sure about this company's ability to execute at the scale we expect. If another customer scaling like this, we believe they are going to. And also, Broadcom itself is throwing around new figures. Their new CEO comp plan depends on AI revenue exceeding 120 billion by 2030. So that's 5 or 6x larger than today. So again, Austin, like you said, I mean, you listed the returns for Broadcom, nearly 100%. It's a company worth, I think it's $1.4 trillion. I mean, that's absolutely remarkable. You almost never see that level of returns for a company that size, but it's because they are quickly being seen as the windows to NVIDIA or NVIDIA's Apple kind of strategy. That's how we positioned them at the beginning. And what we're seeing, I said, both of these can be massive winners. They are both massive winners right now. So, it's been great for Broadcom. And once again, kind of highlights the difference in execution between them and a company like Marvell. Same opportunity. One company's executing, the other's not.
Eric, I have one more earnings to ask you about, but I want to pause on something there that I'm sure our listeners caught, but I find it really important at this moment in time, so I wanted to pause a beat on it. You talked about re-rating, right? What does that mean? And we're not talking about interest rates. Re-rating is basically it's the multiple that Wall Street is willing to subscribe to your revenue or your earnings, revenue if you're not profitable. And this is where narrative does matter a lot. And we've talked a lot about this over the years, right? The ability for a CEO to tell a company's story, to get them in the vein of an exciting industry means that investors then value that future growth at a higher multiple. So one of the best times to buy Apple, throw back to some number of episodes ago, was when they were at 10 times earnings and the narrative was against them, right? And then they get a multiple expansion to 30 times earnings, and they grow earnings, like wildfire on top of that. So you're growing earnings, and the price that Wall Street investors are willing to pay for those earnings goes up by a multiple. And that's the 1-2 punch of amazing compounding. So, re-rating is a big deal, and re-rating is fundamentally about where are you strategically positioned. Reality matters. It's not all story, but it's where are you strategically positioned, and then how well can you explain that positioning to the market so they understand why they should be ascribing a different multiple to it. And it's really important.
It's worth noting too, Broadcom's CEO is an absolute master of this. And Marvell's last earnings call was a complete disaster. The company unable to adequately describe what's happened with their business with Amazon, unable to give any specifics about the future. You compare that to Broadcom, high specifics about the future, a lot of clarity about what's happening. So, who the leadership that you choose to invest in really matters, because it does determine what multiple Wall Street's going to do. And to some degree, CEOs are chief storytellers, and Broadcom's just excellent. It's very easy to understand the story behind this company.
Articulation is a form of execution, and no CEO has demonstrated it better than Tesla, right? Which trades at a multiple that nobody can seem to fathom when you compare it to other, its closest peers like autos. But he articulates a future and a vision that people get excited by, and they ascribe a high multiple to. Ultimately, reality we'll see if that bears out. But that, I think, that is the case study, right? And articulation is a form of execution. All right, moving on. I know it's a full docket today. I want to talk about Ciena's earnings. This is a networking systems company that supports high-speed data transmission. They're kind of like the backbone of the internet. Very boring, but very important in a world where we're talking about rapidly multiplying token usage. And I think it was the last episode we talked about. When we're talking about AI compute usage, this is not like, it's not like Netflix, right? Where if you consume 1 hour of Netflix, it then doubles when you consume 2 hours, right? It's the same amount of data transfer. This is hitting a exponential function because of the types of functions that we're using AI for. So text generation is relatively low token usage, but then you get up to video generation, you get up to agentic usage, which is sort of self-sustaining compute over multiple hours. You get to these much more complicated processes. Data transmission actually gets a lot sexier. So talk to me about Ciena Corp and what was going on in the earnings.
Yeah, the headline of this episode will not be data transmission gets sexy. I will assure you of that. We'll maybe do the Game of Thrones thing. But Ciena, it's funny. If you pull up an all-time chart on this company, it is hilarious. Like, go to Google, type in CIEN, and just look at this all-time chart. I think they IPO'd in 1997. They're up 6% all time. They went absolutely bananas during the dot-com boom.
Wow.
This is a company, again, Austin's looking at right now.
They peaked. Do you know where they peaked?
Yeah, like probably 1999 or 2000.
I meant share. So they're $137 today. They peaked over $1,000 a share. They IPO'd at 129. So they basically, like, 7 or 8x, went to over $1,000 a share, and then they've hung out below $50 a share for 30 years.
Yeah, and this is a company,
20 years, 25 years,
yeah. Yeah, I directed coverage into technology companies. If you'd write an article about Ciena, you'd get 2 readers. I don't know who those 2 readers were. They were probably pretty depressed. This stock was doing nothing. And it had exposure to telecom.
Don't talk about your mom and dad like that. They were there supporting the work that you were doing. They were enthusiastic readers.
If they're still holding it, they've done well. So, but again, it's a company with no catalyst. And when we identified Ciena, I don't know, we've got a lot of new listeners since this time. Ciena is a recommendation. It's up something like 100%. I own options in Ciena in my personal account, not on the AI investor. I think those options are up 800 because there just wasn't a lot of volatility baked into the stock. It's seen as largely boring. And what they're seeing is now a dramatic takeoff because they're going from these old telecom customers to they've got hyperscalers as their primary customers. This year, they're expected to see 37% growth. Next year, they're expected to see 74% growth. So again, the question is, where is the growth most dense and where might exceed expectations? And that's where you want to be investing. So, Austin, I'll just talk about networking for a minute. What a lot of people are about to see is they're about to see the use of scale up, scale out, and scale across. And this is kind of in networking topology, how you think about different areas of being able to kind of create bigger training clusters, inference clusters. And what scale up is the rack density itself. And that's what we've talked about with NVIDIA systems that cost, several $1,000,000. They're just building, they're adding more GPUs to each single rack. And that's been a process that's been happening. It was one of our initial investments was in scale up. Companies like Broadcom, companies like NVIDIA, companies like our memory plays, which are now up a pretty astounding amount. I think Micron's up 70% plus. It's had an outstanding year. Scale out, which is connecting all these racks together within a data center, well, that benefited areas like Credo, which is up more than 500%. And we had specific plays for that. Now, scale across is going to be connecting data centers. We've talked about this being something that is a little bit delayed. It's going to be kind of the third area where you see revenue flow through. We're seeing it flow into Ciena today. We're seeing it flow into these optics companies, which have exposure to it as well. And what that means is they are going to see very higher, much meaningfully higher growth in 2026 than 2025. So, this is just a validation of themes we've been talking about. But it also shows how important it is to understand the technology you're working with and be able to make bets as it flows through. I'll say too, this is why I continue to say things like liquid cooling systems. I think the market still is underpricing stocks like Vertiv, and the growth rates that they have in the past 12 months won't be reflective of what they see in 2026 and 2027. And I continue to tell people, if you are starting out investing in AI today and you don't have your picks already, look at a company like Vertiv to be a first addition to your portfolio.
Fantastic rec there. Eric, we're 45 minutes in and we're just now getting to the meat and potatoes of this segment, which was Neoclouds and Oracle earnings, which is what we had alluded to. So I just want to jump into it. Oracle, we talked a little bit about how amazing this was, but Oracle's up more than 40% after earnings. They gave a little bit of it back, but come on, it was ridiculous. It was a wild reaction for a company that's worth nearly $1 trillion. I think it made Larry Ellison the richest man on earth, surpassing Elon Musk. This is a company that's reinvented itself a million times over. I'm blown away at what they've been able to do. And you talked about something that I found the most, I don't want to say concerning, but surprising. It put me back, and I was how far out they were forecasting. I forget if it was 2029 or 2030. They were talking about doing 144 billion in one division. To forecast that far out, reckless? I don't know. Is it guaranteed? But it seems like it's already booked revenue more or less. So what is this watershed moment? Let's talk about Oracle's earnings, and then let's go into Neoclouds.
And what we want to do is often I'll talk about trends and give kind of an overview. So, as we're making future recommendations or discussions, you can come back and listen to this podcast if you want what the overview is. So we want to give a quick overview. Basically, the cloud computing market's been dominated historically by three companies, which is Amazon, Google, Microsoft. We call these the hyperscalers. As a group, they have a majority of market share. Now, the change that's happening is that these companies used to have, clouds that were for, the prior generation of computing. They weren't built for, these massive GPU clusters and a future world of AI. That presents an opening, Austin. So we've talked about why these companies are gaining market share right now. Amazon's market share is above 30%, but they only get 20% of GPUs. These companies like Oracle and these Neoclouds, they have 7% of revenue-ish as a group, but they're getting 29% of GPUs. So if demand exceeds supply, and these are the companies that are getting the GPUs, it opens up a window for these companies to compete where they couldn't before. The number that should get everyone a little bit of salivating is 28% projected CAGR for the hyperscalers through 2029, the end of the decade, 66% for Oracle and the Neoclouds. So again, we talked about some of the numbers behind Oracle's earnings, how fast the takeoff is. Oracle is quickly going to be, by the end of the decade, if they deliver on this OpenAI contract, a fourth hyperscaler. They're going to be the size of Google, Microsoft, and Amazon.
With a specialty in GPUs, right? And that's the distinction. When we're talking about these cloud companies, everybody knows cloud computing, right? But the thesis there was very much, it was about cost management, right? Outsourcing your costs. You didn't have to build this infrastructure. It was low cost wins. And that's where AWS took market share. Neoclouds are about performance. Neoclouds are about GPUs. This is outsourcing GPU as a service. So they are both clouds, but there is a fundamentally different value proposition. One is you can run your cloud services on AWS cheaper than anywhere else, and it's stable. Neoclouds are, we have the fastest, baddest GPUs, most chips, let's go. And that's for training and that's for AI. So I want to make sure that there's not all clouds are created equal here. And the thesis here is very much different. This is not a low cost provider. This is a Ferrari rental service.
Yeah, and some of the cost is more competitive than you might expect. But it presents an opening, and the reason that it does present an opening is because NVIDIA, again, we talked about who they're selling chips to, but NVIDIA has been financing these companies, and this is just another. You look at NVIDIA, the genius that had to go into building CUDA, the genius that went to building their networking unit, the foresight. They've been investing in all these companies, and a lot of people on Wall Street accuse this of being a Ponzi scheme, but this appears to be a 5-year plan to avoid them being locked into having only 3 customers. What they've done is they've essentially managed to take themselves, if NVIDIA was beholden to 3 customers, they would have had limited upside in the years ahead. Now they're diversifying their customers to a massive degree. So again, this is the genius. It appears to be a genius move by them.
And I hope the hyperscalers are thanking NVIDIA and dodging antitrust bullets here too. NVIDIA planted the seeds to prevent maybe some additional antitrust strays that those companies could have caught if there were only 3 buyers muscling each other out. So they owe NVIDIA a lot right now, not just for their chips, but for maybe spreading their chips across the landscape a little bit more.
Yeah, although they might do a little Game of Thrones, and as NVIDIA's turn around and shiv them in the back. I know there's a reason they're trying to design with Broadcom. But let's talk about who the Neoclouds are. We've established what this opportunity is, and I appreciate layering that on, Austin. It is just helping people understand the high-level opportunity. And who are the companies? Well, the biggest one's going to be CRWV. This was a company that IPO'd at the beginning of the year. They have a $63 billion market cap as we filmed this in mid-September. They have 5.3 in projected revenue to give you so that's more than 10 times revenue. But the other side of that is expectations are they'll grow to 21.5 billion by 2028. So what are the elevator pitch reasons for buying CRWV? Well, they actually, if you look at SemiAnalysis, which does I think the best research in this area, they have the highest rating. That is a combination of things like cost for one, but also security, network performance, and other factors. They actually rate CRWV as being better than AWS, as being better than Azure, as being better than Oracle, better than Google. So they actually have what SemiAnalysis estimates to be the best AI offering. They're a first mover. They have investment from NVIDIA. They're the first to deploy a lot of the cutting edge Blackwell systems that are in so much demand. And Austin, they have a lot of emerging scale in a business where scale matters. So this is a company that has received a premium valuation, but it's because they have a premium offering. Next, we have NBIS. They're at a $23 billion market cap on 576 million expected in 2025. So now we're at closer to 50 times sales, which is getting to the bleeding edge, but expectations are for them to reach 5.7 billion revenue by 2028. They were a first mover in Europe, so they have a differentiated offering where they have expertise in Europe, which is an area where demand will be rising a lot. Thanks to that expertise, they just won a $17.4 billion contract from Microsoft, and they're validated by third parties. They received a gold rating, which is just below CRWV. And puts them on equal level to Microsoft and Oracle from SemiAnalysis. So they have a product that is truly good. Austin, So those are the two main ones. If you're looking at this market, CoreWeave and NBIS are going to come up first, but we have a wave of IPOs coming. We also have a wave of companies that were doing Bitcoin mining and now pivoting towards AI. I'll just mention two of these quickly. IREN, which is Iris Energy, 10 billion market cap, 510 million expecting revenue this year, up to 1.5 expectations are by 2028. Their biggest advantage, they've got a power cost advantage over many other companies. They've been rapidly retrofitting their data centers for Blackwell, and they are amongst the more speculative parts of investing, a favorite because it's believed they're going to win some hyperscaler business coming up. Finally, we have Applied Digital, that's ticker APLD. We talked about them in our kind of YOLO segment because they're small and extremely ambitious and have big plans. I think the stock's done very well since we did that segment. I think they were worth $3 billion at the time when I looked it up before the show. They're at $5 billion. So they've clearly seen some strong gains. And again, Austin, the biggest thing with this market, I would say, when CoreWeave had first IPO'd, I said we would be avoiding it because of the risk profile, and we had Amazon at the time, so we had exposure. What these Neoclouds are, they're essentially levered bets on AI demand exceeding capacity. As long as that situation persists, they will continue to do well. The problem is, over probably a 5 to 10 year time frame, this is a business where scale matters, and it is likely we're going to see a lot more IPOs, and the majority of these companies will either be bought or go under in some form, because this will be an industry that will continue to consolidate. But for now, the dynamics are extremely attractive. Being an AI first cloud company provides an entry point to compete with the hyperscalers that did not exist 3 years ago. So, Austin, we're going to keep discussing this space, and, hopefully this gives everyone an overview that when we discuss it more, they'll have an understanding of the competitive dynamics and the players they can invest in.
Yeah, the criticism I've heard of Neoclouds, of which there are many, has been that it's an industry that exists at a point in time due to constrained supply and one dominant chip and chip manufacturer. But if you subscribe to that, you would have missed out on CoreWeave's 220% run in the last year. So there's always room for a little bit of YOLO out there. And I don't personally hold that view, but I find that is the criticism of it, right? That this is an industry that exists at a point in time. But thank you for that primer. A couple companies to watch. Eric, I want to try and close us out here with a question from listeners. We always like to hear from our listeners. We received a question on YouTube, which I'd love to ask you, and then I'll answer it myself, which is, when evaluating a stock idea, do you have any favorite metrics you use to determine the stock's relative value? And there's a second part to this, which is, with all of the announcements in capital expenditures from the hyperscalers and sovereign nations on data center buildouts, the numbers are just eye-popping. That's putting it modestly. How do you evaluate the timeline of when these massive investments actually end up flowing through to the companies that benefit in these buildouts? And how much of it is generally priced in before the numbers are reported in earnings? This is a two-parter question. I think the second part there, Oracle, which we talked about a lot in this episode, is a great example of that, right? Forecasting this revenue out to 29 or 20 or 30 before it's necessarily hit earnings. So anyway, Eric, what are your favorite metrics, and how do you think about these hyperscaler buildouts, given that we're now talking about 3, 5, maybe even 6-year investment timelines?
Yeah. So it's a good question. It kind of sums up the whole game, right? So, you could talk for a long time about this. For me, a lot of people might look at company specific metrics. I start looking at the overall opportunity. I'm looking much more at markets. I'm looking much more at technologies. And then I work my way backward. I don't always need to understand everything about a stock to make a purchase on it if I'm comfortable about the overall market opportunity. I've heard a phrase before that the day you'll know the least about a stock is the day you buy it. And I believe that to be true. And many of the greatest investors, like a Stanley Druckenmiller, will say part of their advantage is there's a point where you get diminishing returns on knowledge.
Yeah.
And, if you pause yourself with paralysis, trying to know everything about a stock, you often miss out on kind of the periods where its opportunities, its growth areas are undervalued by the market. Perhaps we've done that with some of these Neoclouds because it's been something I've been looking at, It's just we haven't made any active recommendations. We've talked about things like Applied Digital, but this is maybe an example where we maybe should have just pulled a trigger and gotten some level of exposure earlier, and we were too busy in paralysis of analysis. So I would say, how do you know that something's not priced in by the market? I believe that the markets, especially with exponential trends, is not as efficient as we believe it is. The human mind doesn't think well in exponentials. I think it gives you an opportunity to often buy things where growth is underappreciated. I also think until nuanced technologies hit, they are often underpriced. We've talked about in areas like how we're playing the growth of this scale up, scale out, scale across architecture. You can look at a roadmap and know how one technology leads to revenue for the next, leads to revenue for the next, but the market doesn't always price it that way. It's why I believe things like liquid cooling are underpriced, because you look at what's one of the best performing stocks, it would be Comfort Systems, which does a lot of air conditioning for these data centers. I believe that's something that it's already been seen in a lot of growth because it was a favorable technology for prior generations, but I don't believe, again, I would believe that some of these other technologies like liquid cooling that haven't actually been deployed are still underappreciated. So to put that in concise terms, I look for areas with exponential growth that I think are fundamentally limited by the human mind and underappreciated. I think that gives you advantage. I look at markets first. And third, if I'm comfortable with a market size and I have what I feel like is a reasonable understanding of how revenue will flow through in the opportunities, I try and make investments in things that I believe, if you're an expert in the industry, you might believe are fully baked in, but I believe are generally underappreciated. And we've seen this scenario play out time and time again across various AI markets.
God, Eric, I want to leave it at that because that was such a world-class answer, but I did say I'd answer it myself. So maybe we just edit this out because that was really good. But I'll answer two parts of this question, which is, we are talking about the AI investment portfolio here, but the first part of this question is, when evaluating a stock idea, do you have any favorite metrics? So I'll say, in general, for we don't only own AI and tech companies. So if we're talking about general, maybe a consumer goods company or a real estate company or whatever, more run-of-the-mill, non-exponential company, I like to look at revenue growth, price to sales ratio, price to free cash flow ratio if it's a little bit more mature. One of the things I like to look at also is share issuance. Companies can grow really fast and dilute themselves even faster. So you want to make sure that they're not diluting themselves. So I like to, if I'm looking at more traditional stocks, those are some of the metrics that I like. But as you said, exponential growth is extremely hard to comprehend. And it's there's another book recommendation. Maybe we'll do the AI Investor Book Club. I really liked Enlightenment Now by Steven Pinker. And that it sort of talks about the long arc of humanity. But if you want to understand how powerful human ingenuity can be, looking at a book like that and looking at the long-term charts of things like, advancements in every form of technology and lower crime rates and just what the human mind is capable of when compounding over long periods, it helps you appreciate a little bit more what can happen over long scales of time when you just let humans innovate and let them compound. So I really like that your point about thinking about exponential growth a little differently, and I do frame it differently. If we're thinking about sectors that can compound like this, you can't get too hung up on trying to model what will happen in 24 or 36 months because it's inherently unknowable. It changes so fast, but consistently, time and time again, it changes much more to the upside and much faster than people can appreciate, particularly if you let it run. So I sort of separate my investing metrics based on if it's an exponential industry versus a more stable, traditional retailer, consumer goods, industrial type stock. Eric, we came in over an hour. We always try and get in under an hour. So I don't know if that's a victory or a mistake on this one. Listeners, let us know in the comments. We know this was a long one. It was very dense, but we appreciate you listening. Please subscribe. Please leave us a comment. Please leave us questions. We'd love to hear from all of you, and we will see you next time. The AI Investor Podcast is for educational purposes only and should not be considered investment advice.